Hi, Rich Friesen, and in today's lesson we're going to play hardball. That's right, get your catcher's mitts and we're going to throw them hard and fast. And the way we're going to do that is first I want to tell you a story. And this is a personal story that impacted me greatly. And in order to understand the story, I need to give you a background about the options and futures markets that I was trading. So if you don't understand all the things about options and futures, it's really not that important because the impact of the story is about something very different. But for those of you who do have a little understanding of it, this will add a bit more depth. So before I start the story, let me give you some background into the markets I was trading. There was early 1984 and I was an option market maker on the floor of the Pacific Stock Exchange. And I was also on the new product committee where we brought out a brand new product, options on the PSE technology index. It was an index of 100 stocks and we opened it up for options trading. However, this was very unusual because there was no underlying contract. In other words, there was nothing you could hedge yourself with as an options market maker or trade against. So for example, if you're trading Microsoft and you buy 50 calls, you can sell stock to hedge yourself of the directional or delta risk. But we didn't have that. But there was one thing we did have that was a bit unusual, and that is prior to that, the value line, which is a stock index that most of you are familiar with, came out with a futures index. And this was from the Kansas City, it's called the Kansas City Value Line Futures. And the futures index traded like a futures in that it had a basis between that and cash. And it would follow the cash, but it had, because this was brand new and everyone was new to index trading, and it was difficult for the arbitrageurs to actually arbitrage the futures and the cash because of the expense at that time, that we would have big differences between the cash and the futures price. The basis was could be very big, or sometimes the basis could be really small. It was a very volatile spread. Okay, so now we come up with the PSE index, and it has an algorithm, of course, that brings us to a cash index, and the cash index is, it's similar because they had a few overlapping stocks, but they followed the market sentiment roughly, but not exactly. So now I'm trading options on the cash index. So how do I set my option prices on a cash index? Now the value line futures, of course, move radically in terms of the cash. So if I just set it on the cash index, that means because the index is calculated a little bit more slowly, the market expectations are different than where the cash is right now. For example, if a piece of news came out that was very, very bullish, you wouldn't want to sell your options at this price. So what you do is you create an implied future. And much like the Kansas City value line futures, this will follow the cash, but it will also express a basis, a premium, different levels of premium between the futures and the cash depending on the market sentiment. But also I trade options, and I was the major market maker in the pit, and I could also set pretty well the implied volatility. That's the value of options without their intrinsic value, but just the air in them. How much is that worth? And sometimes in quiet markets that gets to be very small, and in very volatile markets it gets to be very large. So now, tendency is when you have a steady uprise, the implied volatility comes down. When you have drops, the implied volatility tends to go up, and so forth. So I've got some things that I can't control, the PSE Tech cash index. I can set the implied future, and I can set the implied volatility. So now we get to our story. I'm going to erase this and we'll start again. And in this story, I am long option premium. I'm on a lot of option premium. And as many of you know, that if this is time, that the value of options becomes worth less and less and less every day until expiration if they're not in the money, and as a result they become worth less and less. Worthless. So I had some option positions that were becoming worth less and less every day, and money was going out of my account every day. But the good news about that is if the market goes up, I get longer, and if it goes down, it gets shorter. So the more active and more volatile the market is, the better I do. So we're trading along on a day where the value line cash is starting to go up and starting to get fairly steep. The PSE cash index is also starting to go along and starting to get a little bit steeper. The value line futures market is started with fairly low premium, and all of a sudden is getting some pretty steep premium between that and the cash. So what do I do as a market maker? Well, obviously I'm going to get killed if I'm selling it where the cash is. So I do the same thing. I take the implied futures and I move them up. Now these aren't a real futures index. This is just where I set my option values. So as it gets more radical or more volatile, of course, I will take and also raise the implied volatility. So options, both calls and puts, get more expensive. So I'm in the pit, and there's 2 or 3 other market makers, and there's one guy, he's really a nice guy. He's a sweetheart. I liked him. We had great conversations. And rather than me being long premium, or what we call lubby at that time, he was short premium or stubby. And what that means, as the market goes up, he gets shorter and loses more and more money. You know, the short calls go up in price, and as we raise the implied volatility, his short puts don't go down in price nearly as much. So he's starting to be in a world of hurt here. So we start moving up, and the cash market just starts all of a sudden scream. It just starts on a vertical rise, just buying. The pits are going crazy. The futures market, anticipating the climb, even climbs faster, and it just goes up. And the premium between the cash and the futures is huge. The PSE cash index is also matching the value line, and it's going straight up too. And the implied future for the PSE, I raise it up really high also. So, and also because of the volatility going on, I'm also raising the implied volatility of the option. So it's getting to the point where this guy in the pit who's short premium is getting really short this market, and he doesn't have that much capital, and he didn't have a futures account. He couldn't hedge it in the value line futures. He had nowhere to go with it. He was trying to buy calls, trying to get long, trying to get out of his premium. There wasn't enough paper because everybody else was buying calls too, and hence another reason why I was raising this all up. But about midday, this march upward, it started to slow and just started to roll over. The PSE cash index also, not quite as much. It was still maintaining some momentum, but the value line was starting to roll. Now, normally what I would do is say, okay, especially during this time when there was no high frequency trading, some patterns in the market were really obvious, and this one was obvious. I knew that it was just over. I mean, this whole market was going to collapse. So normally what I would do is take the implied futures that I had created to price my options, and I would take it down really fast, because the last thing I want to do is have an order come in where I'm buying calls at the top of the market. So normally I would take this and just collapse it. I'd collapse it faster than the blue line here. I would get really aggressive about that. But this time I did something different. I actually took the market. I raised the implied volatility, which means the calls went even higher. I raised the premium, the implied volatility of the options. So all of a sudden the calls that this guy was short just exploded. They just exploded right in his face. And at some point, about 10 or 15 minutes later, he said, I'm out. Rich, I need you to take me out. I'm done for. And I did. I sold calls at an incredibly high implied volatility. I sold calls and bought puts. All right, I sold calls and sold puts at an incredibly high implied futures. And sure enough, as soon as we had completed our transactions, I had taken them out of the position. The PSC started to roll over. The Kansas City value line started to roll over. And I collapsed the implied futures just straight down. I didn't even make stops along the way. Just bang. The implied volatility I kept really high because they were still coming in and buying options. And this other market maker on the floor sold me his position, walked off the floor, never came back, and he went out of business. It took me some time to reconcile that I had actually pushed him to the point he may have survived. He might have survived. I don't know for sure if I had not made that final push. So the question is, was that the right thing to do? Did I do the right thing? Most of you don't have to look in the eye of the person you're taking the money from. You don't have to look in the eye of that person and know that he may never trade again. But I did. And I still did it. And let me tell you why. When you're in a position, and I was long premium, if I don't take advantage of those times that are working for me, when the market goes quiet, it'll kill me. If I don't take the maximum wins and I still get stuck with the maximum losses, I will eventually go out of business. This other market maker, he was short premium. So what happens is, as time goes on, this is time here, he made money every day. If I had taken him out of his position or helped him out, what that means is you can make money when the markets are quiet, and if they get busy, I'm going to insure your account like you're too big to fail. I'm going to insure your account and help you out. No. If you do that, that means that you are putting on risk and you're not getting the appropriate gain. So the question is, what do you do as traders electronically? And how this story translates is that what I want for you is that when things are working for you, when you have those big ones, when you have those opportunities, is to take them without guilt. Take them like you're playing hardball against another team. Take those opportunities, because if you cut those off for whatever reason, guilt, or you are not used to having that much money, or you don't want to risk any money because you've made enough today, you're cutting yourself at the top, but you're still letting your profits or your losses run on the bottom. So the moral of the lesson is, take those wins, take them aggressively, because they are going to keep you in the game. They're going to keep you in the game for as long as you want to play.